Hello, and welcome to 15 for 15. I am your host, John Zalkin from RKW Residential. 15 for 15 is a new and exciting video series where we interview 15 influential real estate people for 15 minutes each, where we will get their perspective on what is happening in real estate during COVID-19. A little bit about RKW. RKW Residential is an award-winning third-party multifamily property management firm with over 20,000 multifamily units under management and a growing footprint spanning 6 states. RKW delivers expertise in multifamily management through its technology, marketing, and customer experience platforms. My guest today is Oren from Blue Arch Capital. Oren is an experienced real estate investor and asset manager. Oren is co-founder and managing partner of Blue Arch Capital, an opportunistic real estate platform focused on investments in value-add and diverse real estate asset classes throughout the Southeast U.S. To date, Blue Arch has raised over $600 million in equity and manages over $1.2 billion in assets, predominantly in garden-style multifamily across the South and Southeast U.S. Oren, it is great to see you, and thank you so much for taking the time to join me on this episode of 15 for 15. I'm really excited to sit with you and have a conversation about the multifamily sector and to get your thoughts on how you're handling your tenants and your debt services. Can you please just briefly expand on your bio and then tell us what you're seeing in the markets right now?
Sure, John. Great to see you too. Under circumstances, quite interesting times we're in. So a little bit about myself. Prior to Blue Arch, I was head of a company, a multifamily real estate company with about 10,000 units across 7 states, 35 properties, give or take. And I did that for about 2 years. That was a lot national. And beforehand, I was head of M&A for Gazit Globe, which was a shopping center platform with about $20 billion of real estate across the world. So I've seen a little bit of those both two asset class in major depth. Today, most of my time is in multifamily, although we have some retail and other asset classes, but that's where I spend most of my time. With respect to what we're seeing now in the market, a lot of uncertainty, a lot of fear. I would say the past couple of weeks, most of our time was spent speaking with our investors, analyzing internally what we can do to prepare for the times ahead. But for the most part, I'm quite pleasant with the fact that we own multifamily as opposed to other asset classes which have seen a much greater hit. So I would say at the moment we're preparing for the worst, but right now it's a wait and see strategy, right? Because it's still before April. We haven't seen rents come in yet, and we have an idea of what we're expecting, but for the most part, we're preparing for the worst, and we'll see what happens in the next week or two.
So what are you expecting come tomorrow's the first, and rents are due? So, we're kind of in the same world. So I'll give you my thoughts afterwards, but I'd love to hear what you're thinking and anticipating come tomorrow, first few days of the month, on your rent collections.
Sure. So, since this kind of started middle of March, all of our March rents came in due. And so we didn't see anything happen during March collections. Depending on which managing partner you ask, you hear other opinions, or different opinions rather. But for the most part, I think we won't experience anything more than 5 to 10% max of delinquencies, requests for abatement, requesting reductions or postponements of rents. On an asset by asset basis, we've been tracking this. And so in some we had received no rent reduction requests. And in some we have received anywhere from a handful to 20. Most of our assets are 3 somewhat 100 units. And so it gives you an idea of the numbers, right? So 5 to 10 requests for rent reductions before the end of the month out of 300 is quite a low number. Yeah. I would also say just so the audience understands what we have, for the most part, we own predominantly garden style in suburban garden style assets in the South and Southeast, a lot in Atlanta, a lot in Dallas, Raleigh, Charlotte, the other Texas cities, and Florida as well. And most of the product is 90s to 2000 built. It's a light value add strategy. And so we buy from mostly in affluent communities. Our average household income is $80,000, give or take. And so within the multifamily space, I would define us as an A minus, B plus asset class. And so, within that space, I think we will see a relatively low impact in comparison to, for instance, other asset classes such as C class or even A that have much higher rents, and people could save a lot more by possibly moving out or things along those lines. So it's a long-winded answer, but somewhere between 5 to 10% in April, and May I think will probably be a bit worse.
Right. Yeah, that's kind of what we're expecting as well. I think everyone's anticipating what comes tomorrow and how many rents. We're doing daily delinquency reports as well for a lot of our clients, so everyone can be really up to date on it. We've given a lot of recommendations. Are you guys doing anything where you're going to be waiving late fees and you're going to be waiving pet fees and some other things to try to help out some of the tenants and just more or less really concentrate on collecting the actual rent and things like that? Or are you guys just going to wait to see? You can do the wait to see approach.
Well, we have a few ideas in mind. I mean, yes, waiving late fees for sure. It's an easy one. We're definitely not evicting anybody. Whether it's because it was more of an internal decision, but regardless what Freddie or Fannie are doing and what instructions we're getting from a regulatory perspective, we're not evicting anybody at this time. But it's really on a case-by-case basis. Some assets will be a little more lenient, assets that we think will get a hit greater than others. But we're waiving late fees. There are no evictions, but we're definitely going to push to collect as much of rent as possible. And keep our occupancy as high as well. So in other words, we're not raising rents, right? So we're keeping them flat or maybe even discounted in certain instances. The idea is to keep occupancy high and heads on beds.
Yeah, no, absolutely. We're expecting high renewals where people won't be probably leaving as quickly as they were before, and so we're gonna, we're looking at that. More than, we do a lot of lease ups as well in the newer product. So that will probably slow a little bit, but we'll get the renewals on the other side. Talking about your lenders and things like that, what are you seeing from your lenders? And give us a little background on who most of your lenders are. Is it agencies? Is it
sure? So we predominantly have agency debt. So it's all Freddie and Fannie. We're low levered. So we came into this sort of crisis kind of well prepared as a philosophy. We're on the more conservative side. Anything we buy is 65% LTV or lower, interest only for a longer period of time. So we're very strong from a balance sheet perspective, and can weather the storm. We've had some discussions with Freddie, but really haven't discussed anything along the lines of abatement or forbearance or not paying interest at the time being, because we think we'll be okay. To be honest, we can sustain from our sensitivity analysis a drop in NOI from anywhere between 30 to 40% and still be able to pay our debt service. In a lot of instances, we're at a 1.8 to anywhere from 1.8 to 3 times debt coverage. So we're in a very good, healthy position. And so, from Freddie's perspective, we're the least of their problems at the moment, and they've communicated this to us, which is a good place to be. Having said that, if things get worse, we may have those harder type conversations. The definition of forbearance and hardship, the way they've defined it, is not that clear. We don't know if a 5% decline in collections and rent is enough to be able to postpone our interest if we so decide to do. But at the moment, I think we're at this stage in the game where we still don't know what the rent collection is going to be in April. It's too early of a discussion.
And how are you getting out in front talking to your investors? Like what are the investors asking? I know you have a lot of foreign investors as well. You guys raise money. So I'd love to hear what their thoughts are. this is one of the first times that the whole world has experienced the same problem at once, where before in the 8 and 9, in the downturn, some countries fared a lot better and America really took it, probably some of the hardest, but now it's everyone's feeling it. So I'd love to hear who your investors are, where they're from,
Sure.
and kind of what their thought process is.
Sure. So we have most of our investors are institutional, U.S. based and a lot from Israel as well. The Israeli investor base, because of the distance and because sort of Israel is a little bit ahead with reaction to COVID-19, there's a bit more fear and worry. And so we're reminding them that, one, we're in a very good position from a balance sheet perspective, from a collections and occupancy perspective. We have, we've tightened our belts a bit where it comes to expenses where we can, right? So we shut down the pools and the gyms and the public areas, the amenities, and so there's a little bit less expenses there. But it's a little bit too early early to make too many cuts. We also want to provide our tenants with the best service possible, who are going to spend a lot more time in the apartments now as opposed to going to work. So it's a balance. And at the same time, we're reminding everybody that the reason they're invested with us is because our strategy is defensive, and multifamily is, in my humble opinion, the most defensive asset class. Time will tell, and whether our thesis is right or wrong, we'll know pretty soon. But I think you saw it in the last crisis, and I think you're seeing it again as well. And so for our investors who have a lot of exposure to multifamily with us, they also have exposure in retail and some hotels and student housing. And it's no secret these guys are suffering much more than we are. And so on a relative basis, I think multifamily, and particularly our asset class and strategy, which is suburban, affordable, but in affluent communities, we will fare out all right. And so we're calming them down. We're having weekly, bi-weekly discussions with them because they're a bit nervous, and rightfully so. But our job is one, to do the best job running the properties, which I think we are, and two is obviously report and alleviate our investors' concern at the moment.
That's great. So I know you guys had a lot of success, and we got to wrap this up in a couple minutes, but I know you had a lot of success raising capital. And then, it seems like that was the easier part. Now the hard part's deploying it. What are you seeing deals? Are you guys going to be deploying capital? You're looking at stuff, or you're going to do the old wait and see for now?
So no, we're looking. We're looking because one, we can do it. We have the capital. We raised our third fund. First close was done in August. At the moment, we raised about 200 million. We're continuing to raise, but at the moment that has stopped because nobody's raising capital at this time. It's a little too soon, and we'll see how that fares. But at the moment, we have about 120, 130 million dollars of dry powder to deploy, and we're looking at deals. A deal that we did have under contract, we're still contemplating whether we do or don't do that specific transaction. But we're actively looking in the market because we think there will be some opportunities. Folks who are overcapitalized and overlevered may have to part from assets, and that may create opportunity for us. Having said that, I think you'll see very little transactions in the next 3 months. I mean, from what we've seen right now, nobody's taking assets out the market. People are pulling deals off the table. This uncertainty, buyers are skittish, and so right now it seems to be like a freeze. The only deals that will happen in the next couple of months are very distressed deals, if at all. But those who really have no choice and have to sell, and I think they'll be few and far between.
So I know we're gonna go over, but this is a great conversation. I figured if I was gonna go over with anybody, it was gonna be my fellow multifamily guy. Let me ask you. You just said you had a deal under contract. Walk us through a little bit about your thought process on moving forward, not moving forward, how you're pricing that asset, where you're coming in with your NOIs. Quickly if you can. But this is the first time I've heard somebody who actually has an asset under contract. I'd love to hear your guys' thought process.
Sure. So the underwriting was performed and happened before this whole Corona situation. And so clearly our numbers are different than what we anticipate them to be now. And so really the question is whether how quickly we think things will come back to normal, whether it's months or a year or years. And the quick answer is that we just don't know. And so the thought process is, and we've yet to make a decision, but we're not hard. And though we like the asset and we believe in the thesis and we would have bought it, if not for this situation, the question is now, is it the responsible thing to do when there's just so much uncertainty in the market? One. And two, you have to take into consideration your investors, whether you want to make a capital call, where a lot of folks have lost 30 to 40% of their balance sheet and assets under management in the stock market. And so it's not only, do we like the asset? Yes. Do I think it will do fine in 10 years? For sure. Will it weather the storm? Yes. Will it get a little hit at the moment? Yes. But we're long-term investors. Having said that, you really have to be cognizant about your investor base as well. And you're not sort of operating in a vacuum. And it's not a distressed deal.
Right.
If this was a distressed deal, it would have been a different conversation. But we're not a distressed fund. We're a light value add fund. And so you really have to ask. So those are the things that we're weighing at the moment. We've yet to make a decision. We'll see.
Well, we're going to definitely have you back in the next couple of weeks because each day something is changing, but I'd love to find out how your collections went for the first week of April, and then also to find out what you guys decided on that. So this leads us to our final thing, which is our lightning round, where I answer you quick yes or no or over under questions. You rapidly fire them up, and then we wrap them out. You ready?
Ready.
Does the 10-year close under 1% at the end of the year?
Yes, under.
Next time you were on an airplane, over under 90 days?
Over.
Next time you attend a networking event, over under 90 days?
Over.
Next lunch or dinner at a restaurant with a client or investor, over under 90 days?
Under.
Is the election suspended, yes or no?
No.
Will Trump win or lose?
Lose.
Does the stock market end over or under 20,000 at the end of the year?
Over.
Does the U.S. COVID-19 infection rate go over or under 500,000 in the U.S. cases?
Cases? Over.
Do you think you will be on a vacation in the next 6 months?
Yes.
Nice. Oren, I can't thank you enough for joining me on this episode of 15 for 15. This was definitely fun. Everyone, we hope you all stay safe and practice social distancing and make sure to wash your hands. Oren, thank you again. I really appreciate it.
Thank you for having me on with pleasure, and I'll hope to see you again soon.
Absolutely. If you have any questions or would like to find this video, please visit rkwresidential.com.